Welcome to today's Talks at Google event. My name is Rob Leeworthy, and I'm very pleased to welcome John Kay today. John is an economist whose career has spanned the academic world, business, and public affairs. John is currently a visiting professor of economics at LSE and a fellow at St. John's College, Oxford. He's a fellow of the British Academy and of the Royal Society of Edinburgh. He's a director of several public companies and contributes a weekly column to the Financial Times. He's the author of many books, including The Truth About Markets, and his latest book, Other People's Money, Towards a Financial System for the Needs of the Economy Rather than Financial Market Participants, is published by Profile Books and out now. Please join me in a massive round of applause in welcoming John Kay. John.
People who don't know very much about finance often ask me, what do people in the city and on Wall Street actually do? And the answer is, to an extent that almost defies belief, what they do is they trade with each other. Let me give you some examples. World trade in goods and services has grown a lot, we all know that. But world trade in foreign exchange, the amount that's traded on foreign exchange markets, is 100 times the total of trade in goods and services. Some of you probably still think that what banks do is they take your deposits and they lend them out to businesses. Actually, if I look at the assets of British banks, then I discover that lending to non-financial businesses accounts for about 3% of their total assets. Lending to other financial institutions accounts for about 70% of it. That is, what they do is they lend to each other and borrow from each other. The total volume of assets that are subject to derivative contracts, that's contracts to buy securities at some price or some time in the future, the total volume of exposures under that amounts to 3 times the value of all the assets in the world, and about 10% of that each is held by JP Morgan or by Deutsche Bank. Some of you will have heard of high-frequency trading, which now accounts for more than half of all the trading on the London and New York stock exchanges. That's essentially done by computers that are programmed with algorithms that trade with each other. And speed obviously matters critically in doing this, with the result that a company called Spread Networks has recently built a link through the Appalachians, which is designed to reduce the time it takes to transmit data between Chicago and New York from 7.3 milliseconds to 6.6 milliseconds. Just to give you some idea of what that means, the physical irreducible minimum is 4.3 milliseconds, which is the time it takes light to travel from Chicago to New York. Now, I think you might ask 2 questions about all of this. One, what is it all for? And secondly, why is it so profitable? Because if we shut the doors of this room and locked them and spent the rest of the day exchanging bits of paper with each other, what we'd walk out with at the end of the day in aggregate would seem to be very much the same as what we walked into it with. What I'm going to talk about this morning is what I call in the book, it's not an original word for me, and it's not a very nice word, it's called financialization. It's essentially the process over the last 30 to 40 years by which the activity I've just been describing, people trading secondary assets with each other, has grown to be such a large part of our economy and such a dominant part of the financial system. It's essentially the change in the financial world that looks like that to the financial world that looks like this. This was the plaque. When Lehman went bankrupt, it was actually sold for quite a large amount of money. This was Gordon Brown opening Lehman Brothers London. Well, I guess you guys are lucky enough not to have a chief executive who's quite like that in your particular business. But that's the impact of financialization which I've been describing. And I want to point out 2 consequences of that, because lots of people think that financial crises are inevitable. That is, they're just something that happens, like hurricanes or earthquakes that happen every few years. This is a story, it's a graph of what has happened to the incidence of banking crises over the last 2 centuries. And you can see a rather clear pattern in this, which is you get a steady increase across the 19th, early 20th century. Then you get a spike in 1929 with the Great Depression in the early 30s. And then you get a period of extraordinary stability through from the Second World War through to about the 1970s. And then the process which I've described as financialization takes place, and you get this steady increase again, followed by the global financial crisis of 2008, we're all familiar with. This is another illustration of what has happened as a result of this financialization process. You've been a lot of talk about inequality in the last year or two, and you can see that in the 4 countries I take on this slide, Britain, US, France, and Germany, in all 4 of these countries, what you get in the first half of the 20th century is a steady decline in inequality. Then in 2 of the countries, Germany and France, you get a leveling out, but what you get in two other countries, Britain and the United States, is the sharp reversal of that trend. And that is clearly very much to do with both the effect of the growth of the financial sector itself and the impact of the financial sector on the behavior of people in large businesses. I could talk a lot more about financialization and its origins and effects, but I want to go back to the question with which I began. If we are all sitting in this room, passing around bits of paper to each other, how do we actually all make profits out of doing it? Well, if I go back to that great crash story, I find out a little bit about that story. Because perhaps the best little book about the 1929 crash is by John Kenneth Galbraith, who's one of the few economists who writes well. I hope to try and imitate him a bit. Galbraith created what he called the concept of the bezel. And what he meant by the bezel was that there's a kind of magic interval between someone actually stealing some money and the people from whom it's been stolen finding out that they've lost it. And in that interval, both parties are imagine they're enjoying the same wealth. Now, one of the ways we can create profits is by bezel. You see, I might have this bit of paper here, which is called very complicated financial instrument. It's actually a sub-senior tranche of a collateralized debt obligation based on subprime mortgages, but you probably don't want to know about that. You certainly don't want to read the thousands of pages which the lawyers have constructed to explain what's in it. And probably no one in the world has ever read these 1,000 pages that explain what is in it. All you need to know, and it's really quite important for you to know this, is that it yields more than 1% more than a US Treasury bond, and it's rated by rating agencies as at least as safe as a US Treasury bond. Now, I'd be willing to beg. I imagine you might be willing to pay a modest premium for that. And actually, when you explain the attractions of it to your colleague sitting beside you, she might be willing to pay a little bit of a premium to you. And we can pass this round, and we can all make a little bit of profit out of passing it on to each other. And I bet you at the back over there are now thinking, can't we join in and make profits in this kind of way as well? And what we can do is we can pass this bit of paper around until everyone appears to have made a profit out of it. Now, one day, someone is going to discover that this bit of paper isn't worth as much as people thought. But so long as that hasn't yet happened, we've created a pool of imaginary wealth which will benefit everyone in the room. Now, that's a caricature, but not a very great caricature, of what happened between 2003 and 2008, which was that banks announced they had made very large profits, paid out a large share of these to their senior employees, and then announced in 2008 that it had all been a mistake, more or less wiped out bank shareholders, and actually, as we know, needed lots of money from taxpayers to keep them going. Another way of creating this kind of bogus wealth is what I generally describe as tailgating. I have a house in France, and those of you who've driven in France will know that if you drive on a French autoroute, you will find that unless you're 20 kilometers a mile, 20 kilometers an hour above the legal speed limit, you will be tailgated by someone who's on your tail, flashing their lights and trying to persuade you to get out of the way. And the thing about tailgating is it works 99% of the time. The tailgating driver gets to his destination a minute or so earlier than people who drive in some kind of sensible, more rational way. One time in 1,000, it doesn't work. But actually what then happens is that there's a kind of cognitive dissonance that separates the accident, which happens one time in 1,000, from the behavior which the other 999 times gave rise to in this. Because actually, and there's always a reason for that, because the reason there's an accident is that someone else made a mistake on the road, or there was an obstruction in the way, or something like that. So there's always an explanation of why this happened. But actually, the real cause of the accident is the driving behavior that gives rise to it in the first place. But these kind of strategies by which you can make sequences of small profits, punctuated by occasional large losses, are characteristic of a whole variety of financial market strategies. So for a moment, instead of talking about what it is that these guys in the finance sector do, I'm going instead to talk about what finance is actually for. Because let's be quite clear, economies need finance. We need finance really for four kind of purposes. We need finance, first of all, to operate a payment system, so that we can pay our bills, receive wages and salaries, so that businesses can trade with each other. We need finance to help us with wealth management. That means we need to transfer wealth across our lifetimes, because we have education when we're young. Eventually we'll be retired. The pattern of earnings over our lifetime is different from the pattern of consumption we want to maintain. We need finance for capital allocation. That is to take the savings of the country and translate them into the capital stock of the country. To take our everyday savings and build houses and roads and bridges and businesses with all of that. And finally, we need finance to help us with risk mitigation. Finance can help share the risks of life among groups of people so that the costs of them don't fall in such an extreme way on particular individuals. Now, what I try to do in the book, which people have found surprisingly original in a sense, is to ask the question, instead of asking what people in the finance sector do, ask the question, what would a finance sector that was devised to meet the needs of the real economy actually look like in terms of these kind of four functions? Now, I don't have time to talk about all of that this morning, so what I'm going to do is to focus on one of them, which is actually risk mitigation. And in order to do that, I'm going to introduce you to rather elegant venue in the United States, which some of you may have heard of, called Jackson Hole. Because way back in 2005, not long before the global financial crisis, the Federal Reserve Bank of Kansas held a bean feast, which it does every year, as a matter of fact. But this one was to celebrate the imminent retirement from the chairmanship of the Federal Reserve of Alan Greenspan. And there were a whole series of laudatory papers about him, with one exception, which is a guy called Raj Rajan, who was then the chief economist of the International Monetary Fund and is now a governor of the Central Bank of India. And Rajan warned about the tailgating problem, which I've been describing. That is, Rajan said, we have this problem with rather technically, more technically, you call it heavily out of the money options, which is going to come around and hit us in the next few years. Anyway, what Rajan said did not go down well, to put it mildly. The discussant of his paper was a guy called Don Cohn, who said, by allowing institutions to diversify risks, to choose their risk profiles more precisely, to improve the management of the risks they take on, financial innovations have made institutions more robust. These developments have also made the financial system more resilient and flexible, better able to absorb shocks without increasing the effects of these shocks on the real economy. And Cohn was followed by another Federal Reserve governor called Ben Bernanke then, who said that banking organizations, he said, have made substantial strides over the past 2 decades in their ability to measure and manage risks, resulting in greater resilience of the banking system. Another Federal Reserve member called Tim Geithner said financial institutions are now able to measure and manage risk more effectively. Risks are spread more widely across a more diverse group of financial intermediaries within and between countries. These changes have contributed to a substantial improvement in the financial strength of the core financial intermediaries and in the resilience of the financial system of the United States. 2 questions that might raise in your mind. One is, how could these guys have been so wrong? And secondly, how was it that the fact that they were so wrong was actually no obstacle, to put it mildly, to their subsequent advancement? It was Bernanke who succeeded Greenspan as chairman of the Federal Reserve, Cohn, whom I began with, who was then appointed as his deputy, and the third speaker I talked about, Tim Geithner, became US Treasury Secretary when Barack Obama became President of the United States. One thing you certainly learn from that, and it's relevant to understanding finance, is what another economist called the unimportance of being right in large bureaucracies. So that's one question you should raise. But the other question is, why were they so wrong? And they're so wrong because they actually misunderstood the nature of the risk process which they were facing. Now, a French economist called Michel Albert, who actually was an academic economist who became chairman of one of France's large insurance companies, wrote a paper in which he described 2 origins of the world insurance industry. The first was this one. This is an image of Edward Lloyd's coffee shop in the city of London. And in the 18th century, English gents would gather in Lloyd's coffee shop and take bets with each other on all kinds of things. They would bet on the longevity of King George I and other grandees. But one of the things they liked to bet on was actually the movement of tides and the movement of ships. And this was the beginning, developed in due course into a marine insurance market. And you will know that Lloyd's of London, which is the institution that developed out of Lloyd's coffee shop, is actually still a leader in world marine insurance. The other origin of the insurance industry was here, up in Switzerland, where Swiss peasants, Swiss villagers would gather together and agree if any of their animals died, the village would club together to buy a new one. There were 2 ways then in which insurance started. One was as a result of people gambling with each other on uncertain events, and the other was mutualization, socialization of risks, so that we manage them collectively rather than managing them individually. And that contrast between risk trading as insurance and risk trading as gambling remains important today. It became very important, and this is relevant to how the financial crisis developed, in the 1990s, when there was one of the financial innovations I was describing that was invented was something called the credit default swap. And the credit default swap was essentially an insurance policy for a loan. If you took out a credit default swap, that meant you would pay or get paid a certain amount of money if a particular loan was defaulted on. Now, the International Securities and Derivatives Association asked the London QC, Mr. Potts, whether this activity was gambling or whether it was insurance. And you can see that if it was gambling, it would be subject to regulation, the kind of regulation and tax we impose on gambling. But if it was insurance, it would be subject to the kind of regulation and tax we impose on the insurance industry. Which was it? Well, any of you who've ever consulted lawyers in London will know that you will stand a very high chance of getting the opinion you want when you ask this kind of question. And the opinion that ISDA wanted and the opinion they got was that it was neither. It wasn't gambling, so it couldn't be regulated as if it were a gamble, and it wasn't insurance either, so it wasn't subject to insurance regulation. That left the question of what it was, but we can perhaps leave that for a little longer in this talk. And that was important to the development, the explosive development, in fact, of this market in credit default swaps over the next decade or so. And most of these contracts were actually written in London because of this rather benign interpretation of English law. But by 2006, oh, right, sorry, I should have mentioned that. If you want to, no, we'll leave that for a moment. We'll go back to our Swiss villagers. What was going on in the credit default swap market was pretty clearly, by 2006, not mutualization of this kind. It was actually gambling. So there are two mistakes that these guys at Jackson Hole were actually making. The first was that they thought they were looking at mutualization, risk sharing, risk spreading, that was actually designed to reduce risk, when actually it was people taking bets with each other on what would happen to packages of Duff mortgages in the United States. Second mistake that they were making was a much more fundamental one, which was that the kind of risks they were talking about weren't the kind of risks that bother ordinary people in everyday life. What bothers ordinary people are risks that are to do with illness and mortality. They're risks that are to do with redundancy and relationship breakdown. They're risks that are to do with accident and catastrophe. And as it happened, just as they were having their conference at Jackson Hole, Hurricane Katrina was blowing into New Orleans. That is actually the kind of risk that actually matters to people. And it wasn't the kind of risk that was being talked about at Jackson Hole. The risk that was being talked about at Jackson Hole was almost entirely risk that had already been generated within the financial system itself by the kind of transaction which I've been describing. So that by 2006, what we had got to in this kind of market was a world in which essentially what we had was gambling. Some of you may have read one or two of the Michael Lewis books. There was a recent one which has partly a description of the high-frequency trading and data link from New York to Chicago I was talking about earlier. But an earlier book was called The Big Short, and The Big Short is about one of the most successful hedge funds in the whole in the course of the financial crisis, a hedge fund which bet against a batch of subprime mortgages in what was called the Abacus transaction facilitated by Goldman Sachs. And this is the guy who in the end became the fall guy for that particular exercise, a guy called Fabulous Fab Touré. And this is him writing to his girlfriend. I had some input into the creation of this product, which, by the way, is the product of pure intellectual masturbation, the kind of thing which you invent telling yourself, well, what if we created a thing that has absolutely no purpose, which is absolutely conceptual and highly theoretical, and which nobody knows how to price? Well, what you do is you sell it to a hedge fund manager on the one hand, and you sell it to a group of dumb bankers on the other. And that was exactly what happened. That was actually The Big Short. And that was where Mr. Potts' opinion actually took us by 2008. The key point I'm making is to say that instead of managing risks effectively, what we have done is created, in effect, a large casino for very substantial gambling of this particular kind. This is not about risk management in any real sense at all. It is the activity we were talking about earlier when we talked about passing round bits of paper to each other, believing we were all making profits for doing so. So that's where we are. What should actually be done about it? Well, when I talk to non-financial audiences like this one, what most people think is wanted is surely we need more regulation of the financial sector. I think that's wrong. I think regulation is in large part of the problem rather than part of the solution. In a funny way, Mr. Potts was right when he said these things, these credit default swaps we were looking at, were neither gambling or insurance. Because the reason credit default swaps had come into existence was to exploit the fact that the complicated ways in which we regulate insurance companies are very different from the complicated ways in which we regulate banks. So if you could dress up a loan to make it look more like an insurance policy, you didn't have to provide as much capital as you would have if it had been simply a loan. That was the purpose of it, although by the time Fab Touré was here, it was simply a form of very large-scale gambling. I think we need not to focus on writing ever more complicated rule books for the financial service sector, which is what we've been doing since 2008. I think we need to address two things: the structure of the industry and the incentives of individuals within it. And unless we kind of focus on these sorts of issues, we're not going to get either meaningful reform, the kinds of behavior from the financial sector which we want, or a financial sector which actually meets the needs of the real economy. What we need to do, in short, is to try and create an industry in which its profitability is related to its capacity to meet the needs of end users of financial services. The kinds of function which I described at the beginning in terms of payment system, wealth management, capital allocation, and risk mitigation. And we need to address some of the personal behavior of individuals within it as well. This is actually a rather more senior member of Goldman Sachs staff describing being interviewed in Congress about the Abacus transaction we were talking about a minute ago. I'd like to end by what's actually in some ways a rather similar video, but it's quite a lot older than that one. It comes from great wartime film Casablanca. I don't think I can top that in ending this presentation to today. Thank you very much.
So we have a few minutes, 10, 15 minutes for questions or so. If you'd like to queue behind the blue microphone in the middle. Whilst you do that, I will kick off with a question. How do we educate the public in general about these sorts of really complicated financial transactions and goings on?
Well, a large part of the story is you don't want to. Partly, right, in the financial system as it is at the moment, if you don't understand it, you shouldn't do it. But I don't know what's under the bonnet of my car. I don't want to know what is under the bonnet of my car. I actually want to have enough faith in the reputation of the car manufacturer to be able to trust in it. If I think of what you guys in Google do, I don't want to know what's behind the Google algorithms. And I don't have to know what's behind the Google algorithms. What I want to do is see if they work, and if they work, I'll use them, and if they don't work, I won't. That's how the market operates as it should properly. You have enough confidence in producers to actually buy products you don't understand fully. And if you don't have that confidence, you don't buy them, or you certainly don't buy them from that supplier. It's not a matter, I think, of educating the public so that they can penetrate all this. It's really a matter of reducing the complexity and restoring the reputation of people in the industry so that people can be more confident in the financial transactions which they make.
Hello, thanks very much for the talk. Given that this behavior seems to repeat itself over many, many years. The people in those positions some of them are not dumb. A lot of them are very powerful. What hope is there, do you think, for us achieving the stability that you showed in the 60s and 70s, given that these people have an inherent interest to do something that's in contrast to most people's interest?
I mean, it's a very pointed question, because I think we all understand, the political power of certain parts of the financial services sector, which makes meaningful reform very difficult to implement. And in the United States, the problems of campaign financing are such as to make it almost impossible. I fear that the answer to that is what will make reform possible is the next crisis. And what, slightly depressingly, I hope I'm trying to write in this book, is a sort of manifesto for politicians who are faced with that next crisis, which they will be at some time. Because one of the things that went wrong in 2008 was politicians were faced with a crisis and had no idea what to do. I've sometimes joked that left-wing parties in Europe, which had been waiting for 100 years for capitalism to collapse under its own contradictions, were thrown into panic by the prospect that it actually might. But that is roughly what happened.
I'm curious to know what kind of response you've gotten from the financial industry with this narrative.
That's very interesting, because it's a lot more positive than you might expect. But the reason for that is that the kind of people in the financial industry who want me to talk to them about this kind of thing are actually the people of whom there are very many within the industry who want to change it. That is, I've talked over the last 5 years to a lot of people, particularly in the asset management business, who are people who would rather like to see a different, more useful financial sector, and who feel constrained at the moment by a mixture of the organizations they work for, the regulation to which they're subject, the expectations of their clients and customers, to go on doing pretty much what it is at the moment. But frankly, the Dick Fulds of the world are not people who ask me to talk to them, and they're not people I particularly want to talk to myself.
Hi there, thanks for a great talk. You mentioned not being in big favour of regulation, but when other people talk about this subject, they often reference the end or the repeal of the Glass-Steagall Act and the combination of investment banking and retail banking after the 1990s as a kind of very important point, and something that we should go back to having that division between investment banking and retail banking in terms of regulatory setup to make sure that that's the case. Do you agree with that, or what's your take?
No, I do agree with that, and I'm not against regulation. I'm against regulation of the kind we have at the moment, which is the endlessly proliferating complex rule book. So the Dodd-Frank legislation in the United States was 1,000 pages, and then you need tens of thousands of pages to implement that particular legislation. What happened, we had banking regulation under what was called Basel I and Basel II, and of course the response when these things didn't work was to invent Basel III, which was even more complicated than these. This is a game that has no end to it. We're just chasing our tails, and since the people who are regulated are typically going to be smarter than the regulators, if only because they're paid quite a lot more, then that is not going to succeed. That's why I would like to go back to the kind of structural regulation you describe in Glass-Steagall. You know, what happened in Glass-Steagall was that it was introduced in 1933 and separated investment banking from retail banking, so that the House of Morgan was broken up into Morgan Stanley, an investment bank, JP Morgan, a retail bank. And I would like to go further and say, what does a modern investment bank do? It issues securities, it gives corporate advice, it undertakes asset management, it makes markets in securities, and it trades on its own account. And I just list these functions and I say there's actually a conflict of interest between each of these functions and every other. So I would like to see an industry structure that has smaller, more specialized, focused institutions that were, as I described earlier, trying to deliver the kinds of services that people in the non-financial economy want, and whose profitability depends on that.
Hi, you mentioned that you want to focus on the incentives of the individual in terms of reducing this in future. In that vein, do you think that there should be or should have been more criminal charges levelled against people involved in the financial crisis?
Yes, I do. The reason there haven't been many criminal charges is partly to do with the politics of the industry, which we've been talking about. And it's partly to do with the difficulty of establishing that people at the top of the organization actually knew, what was going on. So that when we talked about that Abacus transaction, nobody went to jail for that, but Fab Touré was fined a modest part of his bonus for his part in that transaction. Vineyard and the people at the top of Goldman Sachs didn't suffer anything at all. Goldman Sachs itself paid a fine to the SEC, but that's just kind of certain sort of blood money, really, almost a part of the cost of doing business. I think that means we have to introduce stricter liability, which means you don't actually have to demonstrate that the people at the top of the organizations knew about the wrongdoing in their organization in order to be able to make charges and impose penalties. That's where I think we need to go in order to make this work.
You just mentioned that more regulations was not like the answer for this kind of white paper passing around the room problem. And you said it was more about incentives and kind of changing the whole setting of the financial industry. Can you elaborate on that and explain what your thoughts are and how we can actually solve that, especially on the second point?
Yeah, I think a lot of the kind of paper chasing is the product of creating these huge markets and secondary assets. Now, some of the way of offsetting that is for people to understand that in the long run, this activity is not terribly profitable. But a problem we have there is that, which is why people gamble in all kinds of markets, is even if it's not, people believe it is going to be for them. And without changing human nature, there's probably no way we can change that. But what we can do is we can create a world which is much less dependent on these secondary markets. What we think of as a modern stock exchange is, to my mind, a creature of the 20th century. Stock markets came into being in the 19th century, in the first instance for railways and railroads. The reason was you had very capital-intensive businesses like railways and railroads, and you needed to raise these large amounts of money to finance them in fairly small amounts from very large numbers of people. And that model was then developed for breweries, for automobile plants, for petrochemical plants, and so on, over the next century. But modern business isn't like that anymore. And modern finance isn't like that anymore either. Modern business isn't like that, because companies like this one, are actually cash generative by the time they're even large enough to obtain a stock market quotation. Why is Google a listed company? It's a rather interesting case of a listed company in at least two respects. One is it came to market not to provide, not to raise capital for investment in its business in the way in which these traditional companies did. It came to market, if there was any reason for it at all, to provide a liquidity event for employees and early stage investors in Google so that they could get some value out of their investment, either personally or financially in the business. There's a paradox there, that stock market's now a way of getting money out of companies rather than a way of putting money into companies. And the second way in which Google is interesting is, of course, the extent to which it has multiple share classes to enable the founders to keep control of the business, even though it's majority owned, by other people. And the final aspect of that is to say that we don't, in the main, collect savings in small amounts from widely dispersed individuals anymore. Our savings are very largely institutionalized through mutual funds, pension funds, and the like. And that means we can have much more direct relationships between asset managers and the companies in which money is invested. And I think we could and should, and that would be a more stable way of creating and maintaining, the kind of structure that there is in this company, where you actually have a group of investors who are happy to sustain the kind of founder control which is characteristic of the business, but would also allow them to change it if that starts to look wrong for the future development of the business.
So are you saying that the financial sector should get inspiration from Google and how we work?
Well, I think looking at Google, and Google's relationship with the financial sector is quite an instructive way about thinking about the issues of this business. Because one other important aspect of it is that a company like Google doesn't need to own, and mostly doesn't own, the assets which are used in the businesses, because they're office blocks, they're computers, servers, and so on. I don't know in the particular case of Google how many of them it does own, but actually in the majority of these modern knowledge businesses, very few of the assets in the business are actually owned by the company concerned. I was quite amused to discover that that flagship Apple store on Regent Street is actually owned jointly by the Queen and the Norwegian government pension funds.
We'll take the last two questions together.
Speak at the same time, or? So my question is...
I think it's me who has to take them together.
So in the last US presidential election, it was pretty interesting when Mitt Romney disclosed his tax rate, which was, I think, around 12%, because most of his income is obviously from capital and securities and investment income. If you're a steel worker in Pittsburgh and you pay 25 or 30%, it's obviously pretty disturbing. So what do you think should governments, my question is, how do you think government should tax capital income versus, income from labor?
I think what's wrong in the United States there is, and I suspect the main reason Romney paid as little tax as he does, is not actually to do with lower tax rates on capital income than on labor income, but to do with the fact there are many more devices for avoiding tax in the capital income sphere than there are in the labor income sphere. And I would like to do quite a lot about that. I think I probably should stop there in terms of talking about this particular issue in this particular building.
Fair point.
So I think it's clear that there's lots of things wrong and that you'd like to change and lots of people like to change. But as you alluded to, there's not the political strength to do them, partly because there's so much money in the city and in Wall Street that stops politicians from doing that. And I suppose that strength would have to come from us, the people. So I wonder, is there a need for us to be educated, like Rob said, to demand that from our politicians? Because otherwise, I feel like that asymmetry of information of bankers saying, we know what's best, don't get involved, will stop us from ever changing. So do you think that's the reason we need?
Yeah, I think you're right. When we have a load of this unfocused as a public anger. I remember going to St. Paul's churchyard when the Occupy people were in it. And I saw a banner saying, ban high-frequency trading. And I thought, at least there's somebody here who knows what he's talking about. But it turned out that there was nobody who knew what the banner was about, actually, in St. Paul's churchyard. So we actually have to give some focus to that particular activity. And the big fear I have is that if democratic politicians can't give a focus and a channel to that public anger, what we get is what we're seeing at the moment, which is people who will support crazy guys from whatever part of the political spectrum whose main attribute and the only thing they have in common is that they don't like and look like conventional politicians. So in a way, the rise of Donald Trump in the United States and Jeremy Corbyn in this country, although they could hardly be more different individuals, are different aspects of the same phenomenon. And I think it's a very disturbing phenomenon, and one where that is likely to may end up, as it has ended up before, with some of these crazy guys actually taking power. That's what we need to avoid in order to stop ending things on a really depressing note.
Please join me in thanking John Kay. Thank you so much, John.